Hey everyone, hopefully you're having a good day. My name's Andy, channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in there. Let's take a look and see what people are sharing with respect to those topics. You can follow me at finding_finance. And you can join our community at finding-value.com, where I dive deeper into all of these topics. We still have that May Day coupon code going on, and we've got a Saturday, which is today, question and answer session that's occurring at 7 a.m. Mountain Time, which is the release of this video. Eric Nettle says, breaking net oil length, the financial demand for oil just hit its lowest level in at least 13 years. Epic divergence between financial and physical oil markets, and with the 30 to 50 times size difference, the CTAs and algos are winning for now. It all comes down to summer draws. So if we look, what I like to do on these charts, I like to look at the turning points, all these low turning points in history, and see how well oil did after those turning points, because we're right there where that red line is at, which is a very low point at this time. It makes me want to get super bullish on oil. I like to be a contrarian person. I like to take the opposite side of the bet. And with oil length taken out of the market, I think it looks really good. We had a big move in 2016 that resulted in a big move on up. Very good buying points at these two circles here. We had a big move here. I would say the majority of these circles at these turning points, whenever it does turn, are very good buying points for oil and most likely the oil equities. And here's the pricing and where it correlates. So it would have been here and then the move higher here. Would have been these two here. We have the price fall down a little bit at this point before heading higher. It correlates with this here, correlates with this. This is a great buying opportunity here. That's where I purchased it in 2020, late 2020, September, October. That's a perfect time to be buying. And I think right now, not a bad spot to be looking for an entry point into oil. I play with oil equities. Haynesville rigs are holding at 36, but you can look at history here and how far down we've gotten here. Is this a bottom? We'll see. I mean, we've got some upside momentum on natural gas prices, so I would think eventually that the rigs are going to follow at some point. Short term, though, with the rigs being down, I think that the onshore drilling companies are actually good entry points because of the rig count being down so much. And this is the natural gas Baker Hughes rig count. So per Baker Hughes, the nat gas rig count fell another 2 rigs this week to 98 rigs. A new cycle low and down 37 rigs, or down 27% versus last year. It is the lowest that the rig count has been since October 15th, 2021. So here's the rig count in the blue. You can see we've been falling. And year over year change, it's been negative for a while. What is causing this? Why are we dropping rigs? Well, we've got nat gas and the prices crashed, not like this second, but they crashed down to a very low level. It was due to warm weather for 2 winters in a row. And then I look out in the future, and my question is, well, what if we get a cold winter? What does that look like, and how does it change this dynamic? Changed it in a big way. So I'm not betting that we're going to get cold weather. I'm betting that we're at a low point, and that at some point in the future, we are going to have to increase rig count to keep up with increased electricity demand and that demand for electricity is coming from natural gas. And I think that we'll probably get colder winters here at some point. Here is the dude. I get the feeling this is the most manipulated day the stock market has ever had. Fake job numbers, and they bang down gold and silver this much. This must be pure panic. All while the GameStop psyop continues. Here's my opinion, guys. This is what my guess would be. I think Bitcoin and crypto was created because it is not a tangible thing. So they got to suck money into intangible objects. Intangible objects are GameStop. Tech stocks can absorb a lot of money and be very overvalued, but it doesn't impact the pricing of the things in the real world. They need financial assets to absorb this amount of paper in the market. Gold and silver can't absorb it. They don't want people there. And if gold and silver really start to rocket higher, what does that mean for the banks that are short those metals? Do they go bankrupt? I don't know. Like if they were to really take off. So is it manipulated? I don't know. But I could get what I just said is my reasoning of why they may not want gold and silver to go up. The reason that everything is aimed at gold and silver is because that's the revaluation metric that commodities get priced against. So if gold goes way up, it's going to reprice all of commodities higher. That is why they want to manipulate it. Now, absolutely everything is manipulated because they manipulate the dollar, which is 50% of every transaction that you do in dollars. So every transaction that is done in dollars, they are manipulating the price of the dollar. They're manipulating the quantity of it. They're manipulating the interest rate. And the market is bigger than they are. They can hold this stuff down. They can print money and buy a bunch of bonds for a while, but then the pressure starts to build in other areas. So if the pressure is being applied to the bond market, and let's say they want to do quantitative yield curve control or quantitative easing or whatever it is, if they start to buy bonds, then money gets into the system, which is inflationary. Then the pressure mounts on the currency itself. So the way that I view all this is that it is unstoppable. They cannot manipulate it for any, for a very, very long period of time. They can do it for a while until your debt gets out of control. Then it becomes a problem. Then you start to worry about the pressure building in the currency. If it starts to build in the bond market, they'll transfer it to the currency. And that's where it all starts to fall apart. Goldman sees winter global gas price risks skewed to the upside. Whoa, we're getting some upside things here from Goldman. Not that I really give a crap. I mean, I'll be honest, guys, I don't really care what any of these people say. I just kind of go through this and see what people are sharing. I mainly look at the charts and I mainly look at supply demand balances. That's about all you need. Everything else is just an opinion, but they think it's, Goldman sees a winter global gas price risks to the upside versus the downside. Coming down, Peter, he says, standing back, what's happening now is that job openings are being converted into jobs as new entrants join the labor market and those who lost their old job find a new one. Yeah, that's the restructuring the economy that I talk about. Some of these areas are going to lose jobs, like in tech at some point, and then they're going to switch over into the real economy, as we'll call it, and that's jobs in other sectors that are booming. I'm not saying that a tech worker is going to necessarily become a construction worker, but they might aid or help in different sectors like mining, construction, whatever it is. It says the problem in that these job openings are not being replenished. This is why the unemployment rate is going up. It's becoming more difficult to find work. Unless the job openings rate stabilizes, a recession will be hard to avoid. Yeah, but if someone loses a tech job, it may not be the same as the jobs that are open. When I look at this, and again, this is my opinion, 2008 did not have a lot of job openings. That's way down here. But if you look and you go all the way up, I mean, we are at a very high level. We're at a level that's greater than any time in history going back to 2000. So we're still at a very high level. It is coming down, but it's just continues to be at a high level. So that's the comments I'll make there. On a total rig count are down 4 to 492 versus 556 a year ago. It's a new cycle low. Low level here. Now I'm interested to see what oil prices do here and what the drawdowns in inventory are going to do. So we've pulled back on rig count quite a bit, both in oil and in natural gas. And I think that we are getting real close, if not at, the cycle low for oil and natural gas combined rig counts. So I think we're getting real close. Christine says Canada's active rig count came in at 150 this morning, a 28 rig increase compared to last Friday. That is actually a pretty big increase. So up in Canada, things are looking a little bit different. Rig count's been going up, and I do have some investments directly related to that. Dry nat gas production, with that rig count declining, we can see it's also remaining a little bit lower for dry gas production. And this is your change coming on back here with those rig counts going down a little bit. So production is pulling back. We've got Antonio here with Michael Oliver, $160 silver, $8,000 gold. Sounds like too much gold buggery. Well, I wouldn't be out of the it wouldn't be out of the ordinary, says Michael Oliver. And I'm in that camp too. I think we're going way higher. So that's my thoughts over this entire bull market. It may take some time to get there. Sabine Pass, foregoing their typical June maintenance, is quite bullish for nat gas. Exports should be about 1.5 billion cubic feet per day higher for the whole month. That's 40 to 50 billion cubic feet of extra demand versus last year and the 5-year average. It's a reverse Freeport. Freeport went down. It had some problems, and it's been down for a long time. We had it down multiple times, and the takeaway capacity obviously is lower, but now we've got a higher capacity for LNG going forward here. We also have some new stuff coming on in the second half of 2024 for LNG takeaway capacity. Just an FYI. Here's Rashad, and he says, precious metals and miners are getting eviscerated, which is usual ahead of very big moves. The sector is getting hit hard to cause as much panic and calamity as possible to shake out investors. Once this shakeout is over, big upside moves are coming, though not everyone will survive today's attack. I actually think he's right. A lot of investors are too short-term oriented. Obviously not myself, but a lot of people are, and they get scared by these big sell-offs. The big guys have to create fear to get size into the market. You can read how Jesse Livermore, in Reminiscences of a Stock Operator, you could see how he dumped shares onto retail, but he needed to create demand to offload a large volume of shares. They do the same thing. They smoke these things after a breakout, get everybody worried and scared and fear. People feel the fear when they see their portfolio go down 6, 7, 8% in a day in certain positions. They try to get them to sell so they can buy their shares. It's a tactic that some of these big boys do after these, I would say, clear and important trend lines are broken. They're trying to get more size into the market, and they have to scare you to try to get it in. Anas says, is that Anas or Anus? They told us that global oil demand has peaked. We've been telling our clients and readers for years to ignore such unfounded predictions. They told us global coal demand has peaked. We've been telling our clients and readers for years to ignore such unfounded predictions. They told us shale oil production has peaked in 2019-2020. We told our clients and readers to ignore such claims. They told us that gas is a bridge to the future. We've been telling our clients and readers for years that gas is the future. Now the data and policies are clear, and we were right all along. So yeah, I agree with all of this. But I do really agree that gas is the bridge to the future. Totally agree. Totally agree. Gold usually bottoms by the end of June, especially if we get a rate cut in July. And I don't know if we're getting that rate cut, guys. No, but here's the the potential bottom and breakout starts at the end of June, beginning of July for gold seasonality. Game of Trades, he says credit card default rate for small banks have hit 7.8%, a level that has never been seen since 1991. Says this could get ugly. I look at this and I look at it from a different perspective, guys. I look at it like we just went through a slowdown, and when this declines, those are really good opportune times to be invested in certain assets. This one here, after this recession, after it kind of came up and declined, this was the big commodity bull market run. We went from a high level to a low level. We also had a lot of commodities do well from this one, from a high level to a low level. Is this about to turn and go lower? I mean, we already went up. We went up all this way. We already went up all this way too. Are we actually going to get a turn and go lower? I don't know. I mean, we'll see. But we're at a high level compared to history. Makes me think that we could turn lower, which maybe is bullish, or maybe it's another signal that a commodity bull market could be coming because it's got the same type of conditions. But I don't know. That's a far-reaching conclusion. We've got energy here. I already talked about the rig count jumping up. A few things to elicit bad oil takes like OPEC meetings. This week was no different. When the dust settles, market will draw heavily in coming weeks, and OPEC remains committed to stability. Financial length is flush, and oil will rip when USO roll ends. Ignore clickbait. Watch inventories. I agree with inventories, and I do think that we could see draws. So I'm in the bullish camp of oil here. RevCap says people playing for recession and construction and manufacturing jobs still growing. Good luck with that in terms of the recession call. How many years of people panicking about jobs before they realize that it is different, this time running 8% deficits at full employment with no housing supply and AI. So Warren Pye says payrolls for residential construction, total construction, and manufacturing payrolls are still rising. These are the areas that lead broader job losses prior to recession. Totally agree with that. This guy has nailed it. That's exactly what you want to look at prior to recession. But these are going up, not down. We are not in a housing market bubble because these are still going up. Remember, construction jobs are 5% of total U.S. payrolls, but account for 20% of jobs lost historically in a recession. And that's because of the real estate cycle. That's where all of the job losses come from, and that's where you want to be looking. He is completely right. Eric Nuttall says, main hesitations in purchasing an EV are cost, lack of convenience, charging options, and range anxiety. Is that all? Question mark. And this is the likelihood to buy a fully electric vehicle. Look at this. It's unlikely, very unlikely, and it's increasing. I thought if adoption is going to go up, that should be the likely, very likely should be going up. But why is this all declining for the likely and the unlikely increasing? People don't want electric vehicles, I guess, and maybe they're already saturated in the market of people who want them. Here's Tavi. He says, the last time full-time employment declined for 4 consecutive months or experienced over 3 million job losses was during a previous recession. To clarify, I don't believe we are currently in a recession. However, if the Fed is looking for signs of weakness in the labor market to justify cutting rates without appearing desperate due to rising interest payments or political pressures, there are plenty of reasons to consider. And you can see where we're at this current time for U.S. full-time employment. It's year-over-year change in the thousands of persons, and we are a little bit negative here. So we are experiencing a slowdown. Here's Henrik, and I just like reading this stuff because it is true. But I will say he's been wrong on a lot of stuff. I know he's flip-flopped over the years. I know he called for $900 gold. and gold went in the opposite direction on him. But he is right on this. He says the largest equity bubble ever, market cap to GDP, meets the largest speculative bubble ever in crypto, which is true, meets the largest and longest lasting yield curve inversion ever, which meets the longest decline in leading indicators ever, which meets the fastest rise in personal interest payments ever, which meets the trust in money printing can save the real economy. He says this is not going to end well. But first, the continuation of the blow off top. The music is still playing, in his opinion. But that is true that all these indicators and everything are lined up for a potential big crash whenever this does end. I wrote something about myself. So I said, some people call me a perma bull in commodities and a perma bear in technology stocks. I've been bullish in commodities since 2020 and still hold my commodity equities. That would be correct so long that the market conditions are good for commodities to go higher and the value is good in that sector. I will be a bull as long as this is the case and a bear on things that are overvalued. And this is the CRB index to S&P 500. This is what I think is going to occur. And I think that we're at a very undervalued state for commodities. That is why I will remain bullish on commodities the entire way. The second wave pullback is the biggest pullback, and we undergo that in the beginning of the bull market. Also, this is crude oil divided by the NASDAQ. I would be a bull in the NASDAQ in the early 80s all the way to 2000. In 2000, I would shift. And I know that's early because you'd still have a blow off top in 2000. I would start to shift at the bottom over here, about 98, 99. That's when commodities are bottoming. Commodities will outperform tech stocks on a risk reward basis. So I can take less risk and get as good or better rewards buying the undervalued asset at the top of a bubble. Then you want to go become a bull in oil, because this is a crude oil to NASDAQ chart. Another one, you want to be a bull in NASDAQ, and then you want to be a bull in oil here. And that also correlates with the real estate cycle. It's 100% the real estate cycle over these long periods of time, and it's the big imbalances that push oil higher and the devaluation of the dollar. This is the Energy Services ETF OIH versus NASDAQ, the XOP versus NASDAQ, and PSCE versus the NASDAQ. It says it looks like energy is still consolidating at this time against the NASDAQ. And here it is in the consolidation here, the 3M consolidation that's about to break to the upside, in my opinion. And we're at a very low level, which is beneficial to own energy service companies, which is OIH. Then we look at XOP, which is the energy exploration production companies, and that's also got a big flag pattern. We've got a 3-hump consolidation that's ready to break at some point here soon in the future, where XOP is going to absolutely wax the NASDAQ. Then we've got PSCE, which is the small cap energy companies. And we've got the 3-hump consolidation that we've got going on. Now, this very well could do a false breakout where it dips down and then rips to the upside. But this, with time, given where we're at and the momentum that we're starting to generate to the upside, energy, in my opinion, just looking at all three of these ETFs, is going to outperform the NASDAQ over the next decade. So the next decade is the 2020s. There are 4 types of wealth: financial wealth, which is money; social wealth, which is status; time wealth, which is freedom, and that's the one that I value; and physical wealth, which is health, which is another one that I value quite a bit. I can give 2 craps about social wealth. And financial wealth is what supplies me the number 3, which is time wealth and freedom. So he says, be wary of jobs that lure you in with 1 and 2, the financial wealth and social wealth, but rob you of 3 and 4, which is your freedom and your health. I think that's pretty smart to be thinking in those terms. Dr. Gary says the oil price goes down in 3 days, but goes up for 3 months. And that is why it's always more fun to be bullish. Also, I don't believe you can make money being bearish being a bearish trader. In my 50 years of experience, most of the very successful ones are bulls by nature. And I am a bull by nature. I'm more optimistic. I look at the bright things, and I have long time frames where if I see value in the market, I buy it and I hold on. And I think that's all the people who get rich. All the people who stay poor, they try to time the short term, and they just lose money continually. It's an emotional short term game. Oh, I thought this was cool. This is the OPEC Gulf members. They occupy the lower end of the global oil cost curve. So this is the global oil cost curve. This is your cumulative peak oil production. And your swing producer, your one that's the highest cost swing producer, is Canada Heavy Oil. So what I do, and I know some people, they're like, oh, well, you don't want to be in high cost producers. I'm the exact opposite. I look for the low cost producers. I avoid these because those will have the least amount of swings in a big bull market. If I'm bullish on oil, I want to be over here on U.S. shale, Nigeria, and Canadian heavy oil. That's where I would be playing it. And then I would play, onshore and offshore. We've got some stuff over here that I would also play with, maybe energy services or something. Birth rates are dropping big time throughout much of the world and Japan. We just saw an all-time low birth rate last year, and I hate to say it, guys, but these are not good countries to invest in with with declining birth rates like this when they're going negative. And that's the change in births data year to date to the latest readings. And if you're negative like this, I mean, your economy's not going to do well. Your real estate market's not going to do well. It's going to be pretty rough. Here's China's May imports of key commodities. So we've got crude oil down about 9% year over year, 11.1 million barrels. Coal is up almost 11%. Copper ore and concentrates are down about 12%. Soybeans are down 15%. Iron ore is up 6%. And nat gas is up 6.5%. And I just thought this was kind of interesting. Crude oil is kind of sideways there. I know it's getting cut off a teeny bit there. There's coal imports are way up. And then we've got soybeans is up. Let me go right there. Soybeans is up, or it's flat. China, copper's up overall. I mean, it's down a little bit in the short term. Iron ore is up, and natural gas. Looks like natural gas is going up quite a bit here. That looks pretty strong. Patrick Karam says the precious metals complex bull era has not even started yet. No matter what the price of gold or silver currently is, so yeah, it's still very early. And this is gold versus the S&P. We haven't broken that downtrend yet to get us into another big bull market here, I think, soon. We've got new addiction here, Shanghai silver before bed, $35 an ounce, 12.5% premium to the rest of the world, plus a 4.5% tonight, draining silver from west to east, and that turned out pretty poorly in terms of pricing today with that big increase of interest rates. But that's what I've got for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. We are doing that question and answer session right now. So if you want to join, hop on in. Use the coupon code MAYDAY if you'd like to join. And that's all I've got for today, guys. So we'll catch you either at the question and answer session or I'll catch you the next day. See you guys.